Thank you, everyone, for being here with us for our multifamily sponsor and deal analysis presentation. Excited to have you all with us tonight, and hopefully y'all can take away some few good nuggets that you can use when you're analyzing future deals that are presented to you by different syndication sponsors. So without further ado, let's go ahead and get started with a brief background on Pecos Capital. Pecos Capital is a private equity firm focused on investing in value-add B and C multifamily assets. We currently have over 15 million in assets under ownership, comprising over 220 apartment doors. In fact, these pictures you see here in front of you are actual assets we own. Most of these we actually own personally, which has helped us solidify our investment thesis so that we are now looking to raise capital to bring our investors the same returns that we've achieved through our personal real estate investments. Malai will be presenting this subject. He's actually in San Diego tonight, kind of coming to us from the U.S. Open golf tournament. So he took a few minutes away from that to kind of join us with this presentation. So go ahead and take it away.
Perfect. Sounds good. Thank you, Mike.
Malai, before you get started, I was going to ask, how is weather in San Diego?
San Diego's pretty good. It's good. It's been a long day. We were up at 4 o'clock to get to the first tee to watch all of these best of the best players today. Man, this is the first event without masks, which is amazing. So anyway,
I know. You know what? I was debating. There were two things near and dear to you. One is golf. Another one is obviously multifamily investing. I thought golf is going to take precedence, and you're going to skip the demo today. I mean, the presentation. You made it. So now I know what's more important to you.
Thank you. Yes, of course. Yes, this is my passion, of course. Yes.
That being said, go ahead and take over, Malai.
Sounds good. Thank you, guys. I don't have a clicker. Mike, can you actually go to the next slide, Mike?
Yes,
please?
Absolutely.
So that's the agenda. So the agenda is we did the introduction. We'll talk about what's the good, bad, and ugly, and then what do you look for in a sponsor? What do you look for in a market? What do you look for in underwriting assumptions that are presented to you? And what are the return metrics that you should be looking for when looking at a deal? So that's what we would go through. So this is Pecos Capital Managing Partners, myself, Mike, and Mahesh. Mike, do you want to go through it really quick?
Yeah. The disclaimer is just to let you know we're acting solely as principal here and not any other capacity. We may talk about different accounting, tax, legal terms, but we're just giving you, our presentation here. Please consult any, professionals in these matters, in your legal, accounting, and tax matters that we discuss, because everyone's situation is a little bit different. And remember that laws and regulations do change all the time. So be sure to do your own research before, investing.
Perfect. Thank you. So now let's just talk about the good, bad, and ugly. So the first question is, if I hand you guys a deal, I mean, obviously, you're here because you want to invest in multifamily. If I hand you a deal, would you know what is a good deal versus a bad deal? Let alone good, great from good, right? Because I get hit with so many deals. I get presented with so many deals, and that was the premises of this presentation, right? So, so before we go into any of this, we'll just talk about why we are qualified to present this webinar. Obviously, you are giving us 30 minutes of your time, and we wanted to make sure that it's worthwhile. So we have, so we own 4 apartments, the pictures that you see here, and that's it's about $15 million in assets under management. And passively, the managing partners have invested in 6 deals with over 1,500 doors apart, in addition to those 4 apartments that we have. And so that's that. So now let's go back to this. So I've been talking to a lot of people who are interested in investing in an apartment. The first question that they ask is, the general first question in any investment that you ask is, what's the return, right? I mean, how much am I going to make, right? Is that the right question? I'm not sure if that's the right question. I mean, that is a good question, but that's not a good first question, right? So if that's not a good first question, then what should you be looking for, right? So number one, the most important thing is the sponsor. And the second thing is, after you vet the sponsors, it's the market or the asset class, right? Uh, and then next one is underwriting assumptions, which we'll see that in the next slides. And the last question is the return metrics, right? Because typically, if you are not that much experienced in multifamily, you tend to ask, okay, how much am I going to make, right? It's not the return on capital that's important. I mean, that's important. That's why all of us are investing. But return of capital, preservation of wealth is more important than return on capital. I mean, all of us, you know, have heard about Bernie Madoff and, you know, things like that, right? So we don't want any of those Ponzi schemes going on, or anybody who's not capable of running a deal who's running a deal, right? So we want to make sure all of that, and then finally get to the return metrics. So let's go to the next slide. So obviously, you know, so if we're saying sponsors, right? So the big thing is, if you're investing in real estate, all of us think that we invest in real estate, right? That's not absolutely correct, because what happens is we invest in the sponsors. So we invest in sponsors. So the first question is, well, what is important in a sponsor, right? So all of us have, you know, if you're saying sponsor is the most important part of the deal, which to me it is, it's about 70% sponsor. The first qualification is sponsor, right? So if the sponsor is the most important thing, what is the most important trait for a sponsor? Is it knowing a sponsor? Is it liking a sponsor? Or is it trusting a sponsor? Right? Go ahead and think about it. Most of us will probably say, well, they have to be trustworthy, right? Which is true. They have to be trustworthy, but before getting to trustworthiness, you have to know the sponsor, and then you have to like the sponsor, right? So I'm sure there are hundreds of sponsors that are really trustworthy that you probably don't even know, right? Or even if you know all of these guys, you might not like them meaning not as a friend or whatever, but you might not like their strategy, right? Because there are multiple strategies to invest in real estate. There is value add, there is clipping coupons, there is multiple things, and you know, anything and everything in between, right? So you might not like their strategy. So first you have to know them. So let's say, for example, you know how, you know, 10 sponsors or whatever, and then you have to jive with their thought process. Let's say out of the 10, you might like 3 or 4 guys' thought process, and out of the 3 or 4, then you trust one because you build a rapport with these guys, right? Then you trust one. So trust is important, but that's the last one. Obviously, without trust, you're not going to invest. But to get to trust, you have to know, like, and trust. And what happens is, in know, like, and trust, I mean, that's like the triad for building, you know, relationship, right? Any relationship, know, like, and trust is like the biggest triad that, you know, all of us have to follow. So one other thing that you have to look in looking at a sponsor is, how do they operate in their life, right? Do they swing for the fences, right? Are they conservative with their money? Do they just, you know, so if they swing for the fences, meaning if they, you know, just spend more than they earn, how are they going to be different with somebody else's money, right? To me, how you do anything is how you do everything. Because what happens is, you know, if they swing for fences with their own money, they are going to take a lot of risk, unwarranted risk with the syndication money, which is not good and which is not correct, right? And also another thing is, do the sponsors have multifamily experience? Because what happens is syndication seems to be, you know, everybody wants to syndicate, right? Because there is money to be made for sure. And then, you know, everybody wants to be in the real estate syndication these days. Now, one of the biggest questions that you want to ask yourself is, have your sponsors, or the sponsors that you're considering, do they have multifamily experience, right? Or do they have any other business experience, right? Have they handled large sum of money? Because what happens is, whatever money that they are investing or they are syndicating, it has to be in their realm of possibility. Meaning, let's say, for example, in Pecos, right? I mean, we cannot take down a deal that's worth $1 billion. It might be the best deal of the century, but we cannot take that deal down because that is not in our realm of possibility yet, right? So when you're vetting the sponsor, you have to make sure that let's say if we're getting a deal for $10 million, is that $10 million, is that something in their realm of possibility or thought process, right? So that's also very important when you're talking about sponsors. This is all important because we all like to think we are logical, but we're emotional creatures, right? Buy or invest based on their emotions. And they use logic to justify their actions, right? So, I mean, it's kind of hard to believe. Let me say that again. People buy and invest based on their emotions and use logic to justify their actions, right? So that's why you see all of these ads in the TV. They hook you on the emotions, right? And then they actually make you buy stuff, and then you use your logic to buy stuff, right? So make sure you are betting on someone you know, like, and trust, not just as a friend or a coworker or a classmate. Make sure that you know, like, and trust somebody who can manage your money, right? So that's the sponsor side of things. The once you have vetted the sponsors, then you look at the property or the property class or the market, right? So after the sponsors, you look at what markets that the sponsors are in. So, we primarily work with New Mexico and Texas because it's landlord friendly, number one, and number two, we have boots on the ground, right? Even though there are a bunch of other states that have same criteria, which is landlord friendly, Sun Belt and all that stuff, we don't have boots on the ground there. So, so you want to make sure that you want exposure in that market, right? So you might like us, but you might not want to invest in Texas or New Mexico because you already have a lot of deals for investments in New Mexico or Texas. So you want to make sure that you diversify, not just between sponsors. So we have 6 deals that we have invested. Every one of the deal is with different sponsors. So you want to make sure that you have diversification in sponsors. And also the next thing is you want to make sure that you have diversification in markets. So we have invested in, Florida, North Carolina, Texas. So we have a bunch of diversification as a limited partner as well, right? So you want to make sure that you have some exposure in the market that you are looking for. And then after the market, you want to make sure that the property or the asset class is what you want exposure in, because not all multifamily are created equal, right? Even in apartments, there are different classes of properties. There is A, B, C, and D, right? A is like very, very fancy. A is people rent by choice, not by need, right? Like, for example, all of the fancy people who have second apartments in downtown, or like much nicer apartments, are actually because they rent by choice, right? They can always go put a down payment and buy a house, but they rent by choice, right? So if you invest in A class, the returns are going to be, the cash on cash is going to be pretty minimal because there is not a lot of work that the sponsors have to do. Typically, the vintage of Class A is 2000 and up, right? And Class B is a little bit older properties. It's about 1980, post 1980 properties. So that needs a little bit of hand holding and a little bit of work involved. So the more the work, the more the risk, and more the risk, more the reward, right? And C is a little bit older, or a little bit lesser class. 1960s and up is considered C, or it could be even like a little bit lower class, lower quality of build could be considered C as well, right? And D is obviously, you just don't want to deal with D because D is drugs, and you just want to stay away from D. So you want to make sure that if you want to have exposure in A, B, or C, right? C obviously has more returns, but it comes with more risk. And A is less risk, at the same time, less return, right? So these are the things that you want to, after the sponsor, you want to look at the market. After the market, you want to make sure what is the type of property that the sponsor is investing in. And if that's the type that you want your money to be working for you, right? So that's the third one. The fourth one is actually a big one. This is huge. This is the underwriting assumption. So underwriting is, what it means is just valuing the property, right? All of the sponsors, what they do is the brokers will give an offering memorandum. So that's how the deal is pitched to all of the potential buyers. So once the deal is pitched, the sponsors will underwrite, meaning value the property to make sure what they're buying makes sense for them, right? So underwriting, it's all forecasting and it's all based on assumptions because nobody knows how the market's going to react. Nobody predicted COVID. Nobody could have predicted COVID, right? So these are all the assumptions of underwriting which can make or break, right? Just because somebody says, yes, we're going to get you a 15% cash on cash, right? You have to question, how are you going to get me a 15% cash on cash? Right? It is just one small, because we're dealing with a bunch of variables. It only takes one variable to change one variable, but 10 basis points, which is 0.1%, to make a bad deal from 5% into a great deal to 15%. Right? So let's just run through that really quick. The first one is exit cap expansion. Basically, what that means is, if properties are bought at the multiple of the NOI, which is the multiple of net operating income. So even though nobody expects the property to perform poorly, the property is aging, right? So some of the very aggressive sponsors, if they buy it at 5 cap, they will have an exit at 5 cap, right? So that is very, very aggressive and very risky, right? So if you buy it at 5 cap, you have to exit at least at 5.25 cap. So make sure that the exit cap, the cap rate that you're exiting, which is the multiple that you're exiting, is more than the cap rate that you're buying, right? So higher the cap, lower the price, right? So we want to be conservative when we're underwriting the deal. Right? At Pecos, our assumption is we try to underwrite 25 basis points in 5 years, or sometimes even 50 basis points, which is 0.1% a year, depending on how old the deal is, how comfortable we are. Right? So some of the sponsors are aggressive. So make sure that you check the underwriting to make sure that the exit cap is at least 25% more, 25 basis points more than going in cap rate. The next one is the expense assumptions. You want to make sure that the expenses are, ballparkish, it makes sense, right? In a Class A property, you're looking at about 50%. So if there is $100,000 revenue coming in, make sure that the expenses are at least $50,000. If the expenses are $20,000, that's just a red flag right there, right? You need to dig down more and find out what's going on, right? In B and C, you're talking about 50 to 60%, depending on a bunch of things, if it's all bills paid or if it's, like the RUBS, which is, you bill back the water, you bill back the, utility and all that stuff, then the expenses we're looking at 55%. But if all of the bills are paid by the landlord, we're looking at about 60% expenses. So these are just the ballparkish numbers, right? But the bottom line is make sure that the expenses are at least or around about 50%, right? And then the next assumption is a big one, which is the revenue. Everybody buys a deal, or let me step back. Broker always sells a deal telling that, oh, the rents can be pushed up. It's easy for the rents to be pushed up at least $100 a unit. So if you're looking at 100 units, $100 a unit, that's $1,000, right? I mean, that's a lot of, that's $1,000 in rent. I mean, in rent per month, it's about $12,000. So $12,000, the valuation of the property at 5 cap, I'm pretty bad in math. That's about what, $120,000, $130,000 ish. Sorry, I'm bad in math, but anyway. So the valuation, make sure that the revenue assumptions make sense, right? And then the next assumption is, why can you click to the next one, right? Yeah. So the next one is delta from broker's OM. So every deal that the broker pitches to all of the sponsors, what happens is they say, oh, this is the best deal. This is the best deal next to bread, right? Because if they don't make a sale, they don't make money, right? They're going to do everything and anything possible to tell you that whatever deal that they're pitching is the best deal ever, right? So if you have access to the broker's OM, great, right? I mean, that is ideal, because what we have done is, because we invest in the market that we also actively syndicate. So what we do is we get access to all of the OMs before sponsors pick up the deal. So what I personally do is I check the OM and I check the sponsor's underwriting, because the broker also underwrites the deal and says, okay, you know what, this is the best deal, and you can get, this is the revenue, this is the expense, and this is the net operating income, right? So this is what the broker gives. I take that and I see what the sponsor have done. Have they questioned everything that the broker said? Have they changed the rent numbers? Have they changed the expense numbers, right? We just want to see if there is any delta between brokers OM. Most of the time, you're not going to get brokers OM, but if you are able to get brokers OM, nothing like it. You know, there is nothing wrong in requesting the OM when you're investing with a sponsor. Most of the sponsors might get you the brokers OM, but even if you don't, that's fine. But try, right? At least try. And then the next one is refinance part of the base case, meaning we get in for so you invest with a sponsor, right? They're getting in, and are they expecting to refi in 2 years or 3 years, right? And are they expecting a lot of cash back, give you returns, and all of the returns are hinged or based on them refinancing at the end of second year or third year, right? I mean, refinancing is a great thing in multifamily, because when you refinance and when you give them money to the investors, then we're talking about infinite return, right? Because cash on cash is how much money you've invested, how much are you getting on the capital. If the sponsor has given you all of the capital back, then there is no capital that's working. That is your capital. So it is infinite return from that point on. So don't get me wrong, refi is a great thing, but it cannot be part of a base case, meaning they cannot say, okay, you're going to get 15% IRR, and they say, oh, second year, we're going to refinance the property, right? So make sure that these are pretty aggressive things. So make sure that the investment that you're doing is, the refi is not part of the base case, or take out the base case and see what the numbers shake out to be, right? And then the next one is debt and prepay. You know, in multifamily, debt is a huge thing, right? You want, as an investor, it's not like you're signing on the loan or you're getting the loan or whatever, but you better understand that this is nothing like single family home debt, right? The prepayments are huge in multifamily. In single family, you can just pay off, you can refinance anytime you want, you can keep refinancing and paying off the old debt. In multifamily, that's not the case. There is huge refinance. You want to make sure that you understand what debt has been put on the property, and what is the prepay if they decide to prepay or sell within 2 years, or get rid of the property, whatever it is, right? So you just want to understand what the prepay is and what the implications are and how it is done in the underwriting. Right, so that's the underwriting assumptions. Quick check on time. We're 6:28, so we're going to be wrapping it up in about 5 minutes or so, or 10 minutes, maybe 5 minutes. So the last important thing, most of us think that the returns are the most important thing, right? I mean, it's important, but it is not the most important thing. That's what we absolutely have to understand, right? So once you get to the sponsors, you get to the market, you get to the property, and then you check the underwriting assumptions. If everything checks out, then only then you look at returns to see if it actually meets my requirements for returns. Because everybody is different. Everybody's risk tolerance is totally different, right? And so when you're looking at returns, these are the three tripod of returns in typically any investment that you should be looking at, right? Any hard investments or any investments that you should be looking at, right? The first one is cash on cash, right? Is cash on cash important? If I invest $100,000, if I get $6,000 every year Cash on cash is about 6%, right? Which is good, right? So what do you expect in cash on cash? Because if you're retired, you're going to be living off of cash on cash, right? So you need to make sure that you're getting cash on cash if you're retired, or whatever your risk tolerance is or expectation is, that needs to be met. If you're young, if you don't need this money, 6,000 or whatever it is, right? Then you can invest in a more aggressive deal, like for example, development deal, right? If somebody's building a new apartment complex or whatever, what happens is if you invest $100,000, you're not going to see a dime for 3-4 years, and then they'll give you $160,000 at the end of the 4th year or 5th year, right? So in that instance, there is return, but there is no cash on cash, right? So that's the difference between cash. That's the importance of cash and cash, right? So again, in this investment, you cannot take one piece alone and say this is important, that's important. You have to look at holistically. Cash on cash is just one piece of the puzzle, right? The next piece is equity multiple. Equity multiple is, let me give you an example. So you invest $100,000 with Pecos. We give you $200,000. Is that a good investment? I mean, that's $100,000. We give you $200,000, so we've doubled your money. That seems like a great investment, right? But what I didn't tell you is how long did it take for me to give you that money? If I give you $200,000 in a year, that is 100% return. If I give you $200,000 in 100 years, that's nothing, right? So equity multiple is, it's just, whatever is invested at the end, how much do you get? So that is the equity multiple, right? That's also important because you want to see the equity multiple of 1.5 times in a 5-year term, at least 1.5 times, right? Again, equity multiple is just one piece of the puzzle. The next important piece of the puzzle is IRR. IRR is the internal rate of return. Internal rate of return is really just, because $100 today is not the same as $100 5 years from now, right? Internal rate of return takes the time value of money into account. So again, so this webinar is not to go to any of the details of these terms. Mahesh is going to talk about the terms in week after next. This webinar was just to introduce you to what you should be looking for. So just backing up return metrics, you should be looking at all three, but not in silo, not cash on cash, not equity multiple or IRR in any silo. You have to look at holistically, right? I'm getting 6% cash on cash, 15% IRR, 1.5% equity multiple. Well, that's a great deal. If I get 0% cash on cash and 15% IRR, is it a good deal? Well, it might not be a good deal for you. It might be a good deal for somebody else, but it might not be a good deal for you, right? So that's why you need to look at all of these three things holistically, right? So that is return metrics. So, one other thing is, do not be forced to invest in any investment, because now the market is so tight, right? People are getting agitated. People are sitting on cash, right? They think, oh my God, cash is trash. Yes, it is trash. You want to get invested, but make sure that you have a right investment, because these investments are very illiquid, right? You have to know that real estate investments are very illiquid. You're in for at least 5 years, right? So make sure that you don't need that money for 5 years, and make sure that you trust the sponsors and stuff like that. So do not invest because of the fear of missing out. FOMO is the last thing that you want in any real estate deals, right? So the best thing to do is just sit in cash. If you cannot find a good deal, sit in cash. That's why Warren Buffett's sitting in a lot of cash, because he's always looking for deals, right? He only deploys the cash and he finds the right deal, right? So I know a lot of people cannot sit on cash, but remember, cash is a position. You don't need to be invested all the time. So that is what we wanted to cover. Again, our goal today is just to open your minds to options so you can do more research, right? We're not giving you any financial advice or any tax advice or anything like that. Again, we are just solely acting as a principal, and this is more educational. That was the end of the presentation. If you guys have any questions, feel free to let us know.
Yeah, thanks, Juan. That was great. I do like that the tripod of returns and how you can look at all of them a little bit differently. Look at IRR, look at cash on cash, and look at your equity multiple. And they all kind of mean a little bit different thing. They take a couple different things into account. So you look at them combined, and like you said, if you're retired, maybe you want more cash on cash to live off of. But if you're young, maybe you're or even just looking to grow your equity, grow your wealth. IRR, equity multiple can be, in conjunction with the others, can be a really good, thing to look at for that.
So that is what we wanted to present. So if we don't have any questions, we will stop the recording. Thank you all for joining. And we will put up the recording in our website and YouTube and our Facebook account and all the social media that we are in.